Hello students, my name is Shesi George, your professional accounting teacher. Before you continue with this video, please try to subscribe to my YouTube channel. Thank you. Alright, now in this video, we are looking at the concept of NPV, that is net present value with uncertainty. Net present value with uncertainty. Okay, by using this question to demonstrate the concepts. All right, now like I always advise, start from the requirement. The requirement says that calculate the expected net present value of the projects. Okay, then B part says that assuming the demand is certain at 50,000 units per annum, what is the net present value of the projects if fixed overheads are uncertain, as follows. All right, you have been given 100,000. These are the probabilities accordingly. Okay, please, you can pause the video and read through this question. Okay, having done that, now let's start. Dami PLC is considering launching a new product. This will require additional capital investment of 200,000. Then the selling price will be 10 naira per unit. Dami has ascertained that the probability of a demand of 50,000 units per annum is 0.5 with a probability of 0.4 that it will be higher, it will be 20% higher, and a 0.1 probability that it will be 20% lower. The company expects to earn a contribution of 50% and expects fixed overhead to increase by 140,000 per year. The time horizon for appraisal is 4 years. The machine will be sold at the end of 4 years for 50,000. The cost of capital is 20% per annum. Okay, now we need workings here. We need short workings before the presentation. All right, so the first thing is to determine the expected demand. All right, now when we say expected value, expected value, the formula is the real value multiplied by the probability of occurrence. Okay, don't forget, expected value is the real value multiplied by the probability of the occurrence. All right, now in this case we are going to have a short working concerning so we have working note 1. So you can have your workings. So you say calculation of expected demand, expected demand. Okay, expected demand. All right, now to do that, you have been given some guidelines concerning that. We are told that Dami has ascertained the probability of a demand to be 50,000 units. Okay, to be 50,000 units. So what do you have in that regard? You have your demand. At the normal, okay, and is 50,000 units. Okay, it's 50,000 units. Then at the normal, the percentage is assumed to be 100%. The percentage is assumed to be 100%. Okay, then the adjusted, then you say you have to adjust some things here. So you have the adjusted demand. All right, then we have the probability. Okay, don't forget expected demand will be the normal demand, that's the adjusted now, okay, times the probability, like I told you, the expected value times the real value times the probability. Then this will give you the expected demand. Are you with me? All right, so then 100%. So what is 100% of the, that's 100 over 100 multiply by this, we give you 50,000. We still give you the at the normal. Then we are told that the probability is 0.5. So we have 0.5. Then when you multiply, this will give you expected. That's, you are not certain. So you need to attach it with probability. That's the expected value method. Then we have at higher. Okay, then you are told that with a probability of 0.4 that it will be 20% higher. You are not certain, but we have the probability. Don't forget, we are looking at NPV with uncertainty, so the probability will be 20% higher when the when the probability is 0.4, okay, that it will be 20% higher. So the normal demand, we have the normal demand. So we need to adjust for this. We are told that it will be 20%, that is 120. So 20% higher. So we add 20 to this, so it is 120, okay? All over 100. When you multiply with this, okay, 20% higher, and that will give you 60,000. All right, then the probability is 0.4, and when you multiply 0.4 with this, multiply, what do you have? 24,000. Then at lower, all right, 50,000, we are not certain. It will be for lower and 0.1, the probability is 0.1, that it will be 20% lower, okay? So if it is 20% lower, that is 100 minus, that's 80 over 100, okay? Multiply by this, and that will give you 40,000, all right? And the probability is 0.1, okay? When you add this, I think it should be 1, okay? Then when you multiply with this, it's going to give you 4,000. So our expected demand, therefore expected demand is 53,000, okay? 53,000. Let me press calculator, let me confirm. That is 25 plus 24 plus 4, and that is 53,000. That's the expected demand, okay? That's the expected demand. All right, then having gotten this expected demand, we'll need to calculate our working note 2. For the working note 2, so let's come with our working note 2. Working note 2, we need to calculate our contribution per unit, okay? So the contribution per unit from the question is, the selling price is 10 naira per unit. Then they said the machine will be sold at the end of that, the scrap value. Take note, the cost of capital is this. Then I think we have, yeah, they said the company expects to earn a contribution of 50%. All right, contribution of 50%. So all we need to do is to take 50%. So we have 50% multiplied by 10 naira. That's the contribution. okay, and that will give you 5 naira per unit. Okay, then let's the total contribution now. Total contribution will be 5 naira multiplied by the expected value. That is the expected demand, which is 53. So our expected demand is 53 units. Okay, this is 5 naira. Then when you multiply, what do you have? Let's pick up our calculator. So when you multiply, we have 53 times 5 naira and 265. So this will give you 265,000. Okay. All right. Now that is gotten. Then we can now prepare our statement of cash flow. So let's prepare our cash flow statement. So we are preparing our cash flow statement, okay, of Dami PLC. So we can write Dami PLC, okay, for Dami PLC. All right. Conventionally, you have year 0, year 1, year 2, year 3, and 4. Okay, because we are told that the projects we have the time horizon for the appraisal is 4 years, so we stop at year 4. Okay, year 0 we have the cost of the project, the cost, and that cost of the project is 200,000. That's outflow, so it will be in brackets. Okay, it will be in bracket. Then we have our scrap value, and the scrap value for this project is 50,000. So that will be at the end of the project. It will be positive. Okay. The positive. Then we have our contribution, yearly contribution, which is working note 2, and that is working note 2. Then the contributions will start to generate from year 1, which is 5,000, 265,000, 265,000, and 265,000. Okay. Then we have our incremental fixed costs. Our fixed cost. That is incremental fixed cost. Okay. Incremental fixed costs for the project. So we are told that it will be increased by 140,000 per year, dollars per year. That's 140 to be increased. 140,000. And don't forget, this is outflow, is cost. 140,000. That's outflow, 140,000. Okay. Then any other, I think that is all. Okay. Now we look for the difference. So this is 200,000. So when you subtract this, we have 265 minus 140. That's 125 positive. 125,000. 125,000. 125,000. Then here we add 50,000 to this, the scrap value, 50,000. That's 175. So when you manipulate this, we have 175. So this is called the net cash flow. Then the cost of capital is 20%. So for year 1, it will be 1. Okay, for year 1. Then for this, you will just press 1.2. Okay, raised to power So you take up your calculator. This is raised to power 1. Okay, sorry, raised to power minus 1, rather, sorry, 1.2, because it's present value, raised to power minus 1, and that is 0.833. That's 0.833. Okay, then you say answer. So the normal logic is, instead of pressing 1.2 raised to power minus 2, so let's do that. 1.2, okay, raised to power minus 2. 1.2 raised to power minus 2. That is 0.694. So we have 0.694. Then for the third year, we have 1.2 raised to power minus 3. That is 0.579. 0.579. Then for this 1.2 raised to power minus 4 is 0.482. all right, so when you multiply, so we need to multiply. Okay, so why this one is 1 is 1.2 raised to power 0. That is 1. That's why we are having 1 for year 0. Okay, then let us multiply. This is in brackets, don't forget. So we have 200,000. Then when you multiply this, we have 125. Okay, this, when you multiply this, you have this. Use your calculator when you multiply. Then this is called present value. So it's called present value. Then the net present value, that is the expected net present value. You now add this together. So let us add. So to add, we already have this. All right, then you say plus this 1094 or 4125 plus 86,750 plus 72,375, then minus the 200,000. Okay, then at the end of the day we have a positive figure 147,600. That is the expected net present value. Expected net present value. Now, in the next video, I'm going to answer the B parts. Okay, I'm going to answer the B parts. So we'll answer the B parts, okay, in the next video. So if you like this video, please do share with your friends, and don't forget to subscribe to my YouTube channel if you have not done that. Thank you.